creating your risk categories. Now, the risk categories we are creating are just going to be used effectively as a memory jogger by you and your team to help you think broadly and surface the risks that your organization might be contending with. Once we've surfaced those risks, you'll then be going back and redefining them and renaming them based on your specific organization. But we still need to have the right memory joggers or categories that will help your team reflect on what risks. If we don't have this, people tend to just think of the risks which have happened in the last little while, and we need to go beyond that. There are a number of risk category lists that already exist. ISO 31000, COSO, and so on. And different ones are appropriate for different industries. Basel II, for example, are very worthwhile for banking and financial institutions. In our case, we need to understand that the risks we're trying to classify are more than just the regulatory risks and not just the corporate risks. And these differ. If you just use your regulatory risks, there's a dilemma in three categories. One is the duration. Regulatory risks tend to transcend time. They're looking out 5 or 10 years, whereas corporate risk profiles tend to look at near-term things. Secondly, the types of risks they look at. Regulatory filings and risks are usually associated with things that stakeholders are concerned about in terms of future liabilities or performance. By contrast, corporate or internal risks tend to look at things which impact the organization's ability to perform and succeed. The third difference is purpose. Corporate risks tend to be directed towards helping leadership run the organization, although regulatory ones are more biased towards the legal protection and those sorts of issues. So as we take a look at these risk categories, understand we're not just looking at regulatory risk, we're looking at corporate risk. When I use the word corporate, that applies to both the public sector and the private sector. It has to do with the operational aspects of the business, whether it's private or public sector, not just the regulatory aspects. For the sample spreadsheets and the work we'll be going forward, we're recommending that we use the COSO categories. The COSO stands for the Committee of Sponsoring Organizations of the Treasury Commission, and was one of the initial true risk frameworks. And we're using this because the CMA MAG, Identifying, Measuring, and Managing Organizational Risk for Improved Performance, uses this framework, and so we should be consistent. Now, within that framework, they've identified 4 broad categories of risk: strategic risks, operational risks, reporting risks, and compliance risks. And within each one of those, some subcategorizations. In fact, this has a total of 22 categories of risk, and based on a lot of experience, it covers most organizations' broad risk exposure. Now, there's definitions for each one of these strategic risk types and examples, and this is included as a PowerPoint deck underneath this webinar and included in the spreadsheet that you'll be using as you begin sorting out your risk categories. Now, there are other frameworks you can use. I'd like to review those with you just so that you're aware and make an informed choice of what you might use. For many organizations in the manufacturing and, in fact, smaller organizations might want a simpler framework. And a simpler one is based on sort of a process view of an organization. And this one has 13 categories of risk as opposed to COSO's 22. Again, 4 broad categories: operationally or internally controlled, customer-related, environmental, and financial, and then subcategories within those. And again, there's a second spreadsheet attached to this webinar which provides those along with definitions of them. Now, the Institute for Risk Management has sorted out some categories, and this is more detailed. This is about 60 subcategories, and again, for more complex situations, or if you feel any of the previous models are not robust enough, you might want to move in this direction. And again, these are on the PowerPoint spreadsheet attached to this webinar, and you can just cut and paste these categories into the sample spreadsheet. Now, IRM, the Institute for Risk Management in the UK, have also come up with a framework for types of risk. And theirs is kind of interesting. They describe a bunch of externally driven risks, which are things like financial risks, and they include categories like interest rates, foreign exchange, and credit. Strategic risks, competition, customer changes, industry changes, customer demand. Hazard risks, natural events, tsunamis, suppliers, contractors, and other environmental. And organizational, operational risks, which are culture, board, and so forth. Then they say there's an overlap area, which has to do with how the organization responds to those externally driven risks. And in each category, there's some. So, for example, to respond to financial risks, you may set up some decisions around liquidity and cash flow that create different risks. Around strategic risks, there's decisions you make around mergers and acquisitions and integration of entities, research and development, and intellectual capital and intangible assets. Hazard risks are things like choices you make around products and services, public employees and properties. And then finally, on operational risks, things like accounting and controls, information systems, recruitment, and supply chain. Again, this is a different framework, and you may find this suits your organization better. Dr. Kaplan and Annette Mikes came up with a framework in June of 2012, which basically has three broad categories: preventable risks, strategic risks, and external risks. And the biggest issue here is the controls and mitigation opportunities available. And in their Harvard article, they detail out these categories. And basically, the key differentiator that's interesting is they talk about the organization's understanding. So category 1, which are things like employee misconduct and misbehavior, these are what they described as known knowns. Category 2, around strategy execution, are known unknowns, like we know the strategy and risk we're taking, but the risks are unknown. And then category 3, which are external and uncontrollable, are just unknown and unknown. And again, they have a broader definition of each one of these and the sort of mitigation techniques required. So we've gone from middle of the road with 22 categories to very simple with only 3 in this case, and one that has 60 or 70 categories with the IRS. And then multiple others. If you're in the IT environment, you can use COBIT or ITIL and so forth. So there are many frameworks available to you. We're not advocating the use of any one in particular, but we are suggesting you need to consider carefully the risks associated with your organization and which of these categorizations is going to be the best memory jogger for you and your team.